Hi guys! Enjoy John's analysis.
A portfolio manager at one of the largest pension funds in the United States is sitting at his desk at 6:45 in the morning, looking at a number he has never seen before. The number is $14.46 billion. That is the accounting loss Strategy Inc. reported for the first quarter of 2026. Not a projection, not a stress test scenario. An actual reported figure, filed with the Securities and Exchange Commission, reflecting the decline in fair market value of the 780,897 Bitcoin that Strategy holds on its balance sheet. The pension fund manager has spent 30 years stress testing portfolios. He has modeled the collapse of Lehman Brothers. He has run scenarios through the European sovereign debt crisis, through COVID liquidity freezes, through 3 separate banking panics. And as he looks at this number this morning, he is asking himself a question that nobody in his industry has formally published a model for, a question that his risk team has not formally produced a document about, a question that Wall Street's most sophisticated institutions have collectively decided, in what appears to be unspoken agreement, not to answer in public. If Strategy collapses, who absorbs 780,000 Bitcoin? This is not a question about whether Michael Saylor is right about Bitcoin. This is not a question about whether Bitcoin is a good investment. This is a structural question about market plumbing, about what happens when the largest single corporate holder of any asset in human history, an entity that has constructed a $12 billion obligation pyramid on top of a single volatile asset, reaches the moment where the asset can no longer support the pyramid. And by the end of this video, you will understand 5 things that the mainstream financial press is not connecting. First, exactly how Strategy's capital structure works, what triggers a liquidity crisis, and what the actual floor is, because that number has never been published, and the fact that it hasn't been published is itself the most revealing data point in this entire story. Second, the absorption problem. 780,000 Bitcoin is more than 1 full day of global spot trading volume. This channel will show you the mathematics of what a forced liquidation of that scale would do to the market, using the only historical precedent that comes close, and that precedent was 5.5 times smaller. Third, what history tells us about forced Bitcoin liquidations, because there have been 3 major ones in the last decade, and every single one of them produced the same pattern, a pattern that is completely different from what the panic narrative predicts. Fourth, why Wall Street is silent. The institutions that publish research notes on every earnings miss, every geopolitical shock, every bond market disruption have collectively produced 0 public analysis of what happens when the world's largest corporate Bitcoin holder is forced to sell. This channel will tell you exactly why. Fifth, the hidden bull case that lives inside the collapse scenario. Because the most important question is not whether Strategy collapses. The most important question is who the buyers are when it does. Stay with this video, not because of what this channel promises about price, but because the architecture of what is happening at Strategy right now is the most important stress test Bitcoin has ever faced from inside the institutional ecosystem. And almost nobody's reading the filing data carefully enough to see it. Before this channel explains the collapse scenario, it needs to explain the machine that built the position. Strategy did not become the world's largest corporate Bitcoin holder by accident. It did it by constructing one of the most sophisticated financial engineering operations in the history of public markets. Here's how the machine works. Strategy raises capital through 3 instruments. Convertible bonds, which pay near 0 interest and allow bondholders to convert their debt into MSTR common shares if the stock price rises enough. Preferred stock, multiple classes of it, each paying fixed cash dividends. And common stock, sold continuously through at-the-market offerings that dilute existing shareholders but generate cash to buy more Bitcoin. As of April 14th, 2026, the machine has produced the following balance sheet. 780,897 Bitcoin, acquired for approximately $59.02 billion, at an average cost of $75,577 per coin. That is the asset side. On the liability side, $8.214 billion in convertible debt, spread across 6 tranches maturing between 2028 and 2032. On top of that, approximately $3.4 billion in preferred stock outstanding across 4 separate instruments, STAR-K, STRF, STRD, and STRC, each carrying its own dividend structure, its own liquidation priority, and its own escalation mechanism if payments are missed. Total obligations, approximately $11.6 billion, secured against a Bitcoin position currently worth roughly $58.4 billion at today's market price of $74,798 per coin. The coverage ratio looks comfortable. The asset is worth 5 times the obligations. And Michael Saylor has said publicly on the record on the company's fourth quarter earnings call that Bitcoin would need to fall to around $8,000 and remain there for 5 to 6 years before Strategy faces difficulty servicing its convertible debt. That statement is technically accurate. It is also completely misleading about where the actual danger is, because the danger is not in the convertible debt. The danger is in the preferred stock, and here is why. The convertible bonds have near zero cash interest. They do not demand cash. They convert to equity or get rolled over at maturity. The first maturity with real optionality pressure is not until the third quarter of 2027. Strategy has time, as long as it can access capital markets. The preferred stock is different. STRF, the most senior class, demands a 10% cumulative cash dividend on each $100 stated amount. If that dividend is missed, it does not simply disappear, it compounds. At 10% plus 1 percentage point per additional quarter, it remains unpaid, escalating toward a maximum of 18% per year. A missed STRF dividend is not forgiven. It is a debt that grows. STRK pays 8%, payable in cash or in MSTR common shares, giving Strategy some flexibility. STRD pays 10%, but is non-cumulative, meaning missed payments do not compound. STRC pays a variable rate currently set at 11.5% annualized, with monthly cash payments. VanEck's research team published their analysis of this structure in May of 2025 and produced a projection that this channel needs to state precisely. STRK dividend payments alone were projected to rise from $217 million in 2025 to $904 million in 2026 as preferred stock issuance expanded. Combined with debt interest projected to reach $87 million in 2026, total fixed income obligations for 2026 were approaching or exceeding $1 billion annually. Strategy's software business generates approximately $475 million in annual revenue. It does not generate $1 billion in free cash flow. It does not come close, which is why, in December of 2025, Strategy did something that its bulls have largely minimized and its bears have largely exaggerated, but that this channel needs to state exactly as it is. Strategy established a $2.19 billion USD reserve, funded entirely by selling MSTR common stock for the sole purpose of covering preferred stock dividends and debt interest. The company's own press release stated this with precision. The reserve was intended to cover, quote, at least 12 months of dividends, with the goal of ultimately covering 24 months or more. Read that sentence again. The world's largest corporate Bitcoin holder spent $2.19 billion in late 2025 not to buy more Bitcoin. It spent $2.19 billion to prove to its own preferred shareholders that it could pay them in cash without touching a single coin. That is not a sign of structural strength. That is a sign that the machine recognized it was one bad quarter away from a preferred dividend crisis and chose to build a buffer before the market noticed. The buffer exists. The question this channel is asking is what happens when the buffer runs out. At a $1 billion annual obligation run rate, the $2.19 billion reserve covers approximately 26 months of payments. Strategy's own stated target was 24 months. They are at the bottom of their own comfort zone right now in April of 2026, with Bitcoin trading below their average cost basis, and they are still buying Bitcoin. The April 13th, 2026 8K filing disclosed a purchase of 13,927 Bitcoin for approximately $1 billion, funded entirely through STRC preferred stock issuance. Each new preferred share sold increases the annual cash obligation floor permanently. There is no maturity date on perpetual preferred stock. The machine has no off switch. The number is 780,897. This channel is going to spend the next several minutes making sure you understand exactly what that number means in the context of global Bitcoin market structure. As of this morning, April 14th, 2026, Bitcoin's global 24-hour spot trading volume is approximately $52 to $56 billion, according to CoinGecko and CoinMarketCap live data. During Q2 of 2025, when markets were more active, the daily average was approximately $96 billion. Strategy's 780,897 Bitcoin at today's price of $74,798 is worth approximately $58.4 billion. That is more than one full day of total global Bitcoin spot volume. That single fact is the architecture of the absorption problem. But there's a second number that makes it more precise. According to CryptoQuant data confirmed by Spotted Crypto as of early April 2026, total Bitcoin held across all centralized exchanges globally stands at approximately 2.21 million Bitcoin, the lowest level since December 2017. That is 2,210,000 Bitcoin available for immediate trading. Strategy's position represents 35% of all the Bitcoin currently sitting on exchanges. If a forced sale of Strategy's position began tomorrow, The sellers would be attempting to move an amount equal to 35% of every coin available for purchase on every exchange on Earth. The only historical case that comes close to this scenario is the Mt. Gox trustee distribution of July 2024. 142,000 Bitcoin entered the market. CoinShares research analyst Luke Nolan published a study projecting that a worst-case simultaneous sale of the entire Mt. Gox tranche would produce a 19% single-day price decline. That was 142,000 Bitcoin. Strategy holds 780,897 Bitcoin. That is 5.5 Mt. If the CoinShares model scales linearly, and this channel acknowledges it would not because price impact is nonlinear and would accelerate, 5.5 Mt. events represents a price impact that has no institutional playbook, no historical precedent, and no publicly modeled scenario from any major bank, ratings agency, or regulatory body. There is one obvious candidate for absorbing a block of this scale, BlackRock's IBIT. According to CoinGlass tracking data cited by FEMEX on April 14, 2026, IBIT holds approximately 782,000 Bitcoin in custody, with $54 billion in AUM and 49% of all U.S. spot Bitcoin ETF market share. Coincidence worth noting, IBIT holds almost exactly the same number of Bitcoin as Strategy's entire position. But here is the difference that matters. IBIT processes $3.2 billion in daily trading volume. Strategy's position at today's prices is $58 billion. If IBIT were the sole buyer of last resort and could absorb its entire daily volume toward a single purchase, it would take approximately 18 trading days to absorb Strategy's position without moving the market. 18 days of headline risk, 18 days of every media outlet on Earth running Strategy collapse stories, 18 days of retail investors watching the number go lower every day. The all-US spot Bitcoin ETF market combined held approximately $128 billion in AUM as of mid-March 2026. The entire ETF ecosystem received $18.7 billion in net inflows in all of Q1 2026. That is $18.7 billion over 90 days. Strategy's position is $58 billion. The institutional infrastructure that currently exists to absorb this position is structured around passive daily inflows of hundreds of millions of dollars. It is not structured around an emergency purchase of $58 billion in a distressed environment. But this is not a reason to panic. This is a reason to understand precisely what kind of event a Strategy collapse would be. It would not be a market correction. It would be a structural stress test of the entire Bitcoin institutional ecosystem in real time. Before this video reaches its most important section, this channel needs to show you the pattern that every major forced Bitcoin liquidation in history has produced, because the pattern is counterintuitive, and it is documented. This channel will cover 3 events: Mt. Gox, FTX, and the United States government Silk Road auctions. Mt. Gox, July 2024, 142,000 Bitcoin, the largest creditor distribution of seized Bitcoin in history. The market knew it was coming for months. The headline risk was enormous. Bitcoin's price dropped 6% in a single session on the day the transfer was announced. Over $1 billion in derivatives were liquidated, the largest single-day liquidation event since the FTX collapse, and then this happened. JP Morgan analysts published a note the same week, cited in CNBC on July 4, 2024, stating the following: the bank's analysis expected crypto prices to come under further pressure in July, but to start rebounding from August onwards. That is exactly what happened. But here's the more important data point. Galaxy Digital's head of research, Alex Thorne, published analysis showing that thousands of Mt. Gox creditors had waited 10 years for their Bitcoin and resisted aggressive buyout offers for their claims the entire time. JP Morgan's own note confirmed that most creditors chose in-kind repayment, taking their Bitcoin back rather than selling it, primarily for tax reasons, because disposing of coins acquired at approximately $600 in 2014 would have created catastrophic capital gains exposure. The revealed preference of the Mt. Gox creditors, after 10 years of waiting, was to hold the Bitcoin. The pattern: short-term price shock, rapid recovery, and the coins transferred not into the open market, but into the hands of long-term holders who did not sell. FTX, November 2022. The most contagious crypto event in history. A $16 billion fraud revealed overnight. Bitcoin fell from approximately $20,000 to $15,700, a 21% decline over 2 months. Academic research published in Science Direct in January 2023 found that while Bitcoin experienced significant abnormal negative returns, traditional equity markets, currency markets, gold, and energy markets were largely unaffected by the collapse. Bitcoin bottomed approximately 12 months after the collapse and entered the bull cycle that would take it to $126,000 in October 2025. The pattern: short-term shock, irrelevance to the broader financial system, and a complete recovery within one halving cycle. The United States government, Silk Road auctions, 2014 through 2023. The U.S. Marshal Service auctioned approximately 173,000 Bitcoin seized from the Silk Road darknet marketplace across multiple auctions over nearly a decade. The 2014 auction of 29,656 Bitcoin was won primarily by venture capitalist Tim Draper at approximately $632 per coin. Subsequent auctions attracted institutional buyers, including Coinbase. The government sold Bitcoin it seized at prices ranging from hundreds to tens of thousands of dollars per coin, and in every single case, buyers were waiting. The pattern across all three events is identical. Short-term price decline, transfer of coins from distressed sellers to long-term holders who never sell, complete price recovery. And in every case, the buyers who acquired large blocks of Bitcoin in distressed conditions treated those acquisitions as the most profitable trades of their careers. This pattern does not mean a strategy collapse would be painless. It means the pain would be temporary and the outcome structural. Here's the fact that this channel wants you to hold in your mind for the rest of this video. As of April 14th, 2026, not a single major bank, not Goldman Sachs, not JP Morgan, not Morgan Stanley, not Bank of America, not Citigroup, has published a public research note modeling the systemic market impact of a forced liquidation of Strategy's Bitcoin holdings. JP Morgan's crypto desk, led by analyst Nikolaos Panagiotsoglu, has published liquidity analyses for Bitcoin. It has published notes on Mt. Gox's selling pressure. It has published notes on ETF flows. It has not published a single note asking what happens when a company holding 3.7% of the total Bitcoin supply is forced to unwind its position. The SEC has not designated Strategy's Bitcoin concentration as a systemic risk in any public document. The Federal Reserve's financial stability reports have not mentioned it. The FDIC has produced nothing. No congressional hearing has directly questioned Michael Saylor about forced liquidation scenarios. The institutions that produce research notes on every geopolitical shock, every commodity supply disruption, every credit event in the emerging market debt space have collectively said nothing about the most concentrated single-entity Bitcoin position in the history of the asset class. This channel will now tell you exactly why. Part of the answer is the short interest data. According to Goldman Sachs data and FactSet rankings reported by CoinDesk on February 25th, 2026, Strategy is the most shorted stock relative to market capitalization among all global equities, valued above $25 billion. Short bets against MSTR equal approximately 14% of its market cap, the highest reading Goldman and FactSet have ever tracked for a company of this size. 50-plus hedge funds hold disclosed short positions in MSTR, but here is what the mainstream interpretation of that data misses. Most of that short interest is not a directional bet that Strategy fails. It is a basis trade. Firms like Jane Street have disclosed simultaneous large positions in both MSTR and BlackRock's IBIT, long on Bitcoin through the ETF, short on the MSTR premium above Bitcoin's underlying value. They are not betting on a collapse. They are harvesting the gap between what MSTR's equity trades at and what the Bitcoin on its balance sheet is actually worth. As of March 30th, 2026, short interest in MSTR exceeded 35 million shares, approximately 11% of the float, according to Protos analysis. And Protos identified a new and more structural driver of that short interest. Each new STRC preferred share issued creates a permanent cash obligation that the market knows will ultimately be funded through MSTR common stock dilution. The short sellers are not just betting against Strategy. They are front-running a predictable dilution machine. None of these sophisticated market participants have published a collapse scenario because they do not need to. The structure is already priced into their positions. The research note is their trade. There's a second reason for the silence, and it is more uncomfortable. S&P Global assigned Strategy a B- credit rating in October 2025. That is speculative grade, junk in plain English, and in its analysis, S&P gave Strategy's Bitcoin holdings 0 credit as collateral. 0. The rating agency that stress tests every corporate balance sheet on Earth looked at $58 billion in Bitcoin and decided that none of it counted as collateral for the purposes of credit analysis. That is not an accident. That is a structural judgment that Bitcoin's volatility makes it an unreliable asset for debt coverage purposes. Wall Street is not silent about Strategy's risk because it does not see the risk. Wall Street is silent in public because the risk has already been priced into private positions, and because the institutions that would write the research note are either invested in the trade or uncertain about the legal and reputational exposure of publishing an analysis that could be read as market manipulation. The silence is not ignorance. The silence is the price signal itself. If you are still watching at this exact timestamp, this channel needs a moment to acknowledge something. You are processing a structural financial analysis of the most concentrated institutional Bitcoin position in history, while most of the financial world is focused on the daily price chart. You're not a passive viewer. You are doing the work that institutional risk teams should be doing and are not doing publicly. To help this channel understand where the engineered markets community is as this analysis is being processed, do something simple but important. Comment your city, your exact local time, and the current weather where you are watching this video right now. Whether you're watching the morning light come up in New York, the afternoon heat in Houston or Miami, a clear evening in Phoenix or Los Angeles, a rainy morning in Sao Paulo, or a late night in Singapore, this channel wants to see the geographic distribution of who is reading this architecture in real time. Comment below, and this channel will continue. This is the block that the bearish narrative about strategy consistently refuses to engage with. And it is the most important block in this video, because the question this channel has been building toward is not whether strategy collapses. The question is, who are the buyers when it does? And the answer, when you read the documented evidence carefully, is the most counterintuitive conclusion in all of institutional finance right now. Start with the supply architecture. Bitcoin held on centralized exchanges stands at 2.21 million Bitcoin as of early April 2026. That is the lowest level since December 2017. According to Spotted Crypto's on-chain analysis, whale addresses holding over 1,000 Bitcoin accumulated approximately 270,000 Bitcoin in the 30 days preceding this analysis, the largest monthly whale accumulation since 2013. The coins are leaving exchanges. The coins are moving into cold storage. The coins are being held by people who are not planning to sell them. Now add the institutional infrastructure that did not exist in any previous Bitcoin bear market. On April 8th, 2026, Morgan Stanley launched MSBT, the Morgan Stanley Bitcoin Trust, on NYSE Arca, becoming the first major U.S. commercial bank in history to issue a proprietary spot Bitcoin ETF. The fund charges a management fee of 0.14%, the lowest in the market, undercutting BlackRock's IBIT by 11 basis points. Bloomberg senior ETF analyst Eric Balkunas ranked the debut in the top 1% of all ETF launches in history. Morgan Stanley manages $9.3 trillion in total client assets across 16,000 financial advisors. A bank that published a research note in December 2017 titled Bitcoin Decrypted, concluding that Bitcoin's real value could be zero, launched its own Bitcoin ETF 9 years later and charged the lowest fee in the market. That is not a footnote. That is a structural reversal that defines where the institutional ecosystem now stands. Strategy's CEO, Phong Le, ran the mathematics of Morgan Stanley's distribution potential directly. If Morgan Stanley allocated just 2% of its assets under management to MSBT, that would represent approximately $160 billion in Bitcoin buying pressure. $160 billion of potential demand is sitting behind 16,000 Morgan Stanley financial advisors right now, none of whom have been given the authorization to recommend Bitcoin at full institutional scale yet. Now add the sovereign layer. On March 6, 2025, President Trump signed Executive Order 14,233, establishing the Strategic Bitcoin Reserve. The order is precise about one thing that matters for this analysis. The United States will not sell the Bitcoin in the Strategic Bitcoin Reserve. As of February 2026, the U.S. government holds approximately 328,372 Bitcoin per Arkham Intelligence estimates. The Bitcoin Act of 2025, Senate Bill 954, introduced by Senator Cynthia Lummis, authorizes the U.S. Treasury to purchase up to 1 million Bitcoin over 5 years, to be held for a minimum of 20 years, with a stated policy of never selling. The United States government has legally committed to never selling its Bitcoin and is pursuing legislation to become the largest sovereign Bitcoin purchaser in history. In a collapse scenario for Strategy, the most legally constrained and long-term oriented buyer on Earth is a structural accumulator. Arkey Invest CEO Cathie Wood stated in January 2026 that the Trump administration may accelerate purchases toward the 1 million Bitcoin target before the midterm elections. If the U.S. Treasury acquired even a portion of a distressed Strategy position at a discount to market, it would not just stabilize the market, it would complete the largest single expansion of U.S. sovereign Bitcoin holdings in history. Now, look at the pattern this channel showed you in Block 3 again. Mt. Gox creditors waited 10 years and kept their Bitcoin rather than sell. U.S. government Silk Road auction buyers in 2014 held at $632 per coin and never sold. Bitcoin recovered from FTX, the worst fraud in crypto history, within 12 months and reached $126,000. Every prior forced liquidation produced the same sequence. Short-term price shock, transfer of coins from distressed sellers to permanent long-term never-sell holders, supply compression, recovery, a strategy. Collapse at current prices would be a supply compression event disguised as a catastrophe. 780,000 Bitcoin would not disappear. They would transfer from one set of hands into the deepest, most permanent institutional and sovereign pockets on Earth. This channel presents the bear case in every video. In this video, the bear case deserves more precision than usual, because this channel is making a structural argument that could be read as dismissing risk that is very real. The bear case for Strategy is as follows. Strategy reported a $14.46 billion unrealized loss on its Bitcoin holdings for Q1 of 2026. Its stock declined more than 25% in Q1, alongside Bitcoin and the broader crypto market. Bitcoin now represents more than 90% of Strategy's total assets, according to TipRank's analysis, amplifying every price movement into an amplified balance sheet shock. At a sustained Bitcoin price below $60,000, S&P analysts identified the risk that $5 billion in convertible debt maturing in 2028 would be out of the money, forcing Strategy to a brutal choice: liquidate Bitcoin at depressed prices or restructure debt in a default scenario. Independent analysis at BN Crypto estimated Strategy's bankruptcy threshold at approximately $23,000 per Bitcoin as of late 2025, the Bitcoin price at which liabilities would exceed the value of the Bitcoin asset. That threshold has risen as more preferred stock has been issued. The preferred stock dividend escalation mechanism is the most dangerous short-term trigger. If Bitcoin declines sharply enough that capital markets close to Strategy, meaning MSTR common stock, can no longer be sold at prices sufficient to fund preferred dividends, the $2.19 billion USD reserve will begin to deplete. At a $1 billion annual dividend run rate, that reserve lasts approximately 26 months. After that, Strategy must either sell Bitcoin or default on preferred dividends. A default on STRF preferred dividends does not trigger automatic liquidation, but it does trigger the compounding escalation to 18%. It does prohibit Strategy from repurchasing common shares, and it does create a legal environment in which preferred holders have priority claims over common equity in any restructuring. The narrative collapse risk is equally serious. If the company that defined corporate Bitcoin adoption is forced to unwind its position at a loss, the mainstream financial media will write a story that is technically accurate but structurally misleading. The headline will read, "Bitcoin company forced to sell proves critics right." That headline could delay the next wave of institutional adoption by years, regardless of whether the underlying Bitcoin market recovers within 12 months. And there is a supply shock scenario this channel has not yet named. At current exchange reserves of 2.21 million Bitcoin, Strategy's 780,000 Bitcoin represents 35% of all coins available on exchanges. In a forced sale scenario, even a partial liquidation would reduce those exchange reserves by a percentage that the market has never absorbed in a compressed time frame. The bear case is real. This channel states it with precision, and it does not change the structural argument this video has been building. Before the conclusion of this video, this channel needs to name the one thing it could not verify. Across all of the research layers that produced this video, SEC Edgar filings, VanEck analysis, Goldman Sachs data, CoinShares liquidity studies, CryptoQuant on-chain analytics, there's one number that does not exist in any public document. There is no verified, published, sourced figure for the specific Bitcoin price at which Strategy's balance sheet becomes technically insolvent under FASB ASC 820 fair value accounting rules. Michael Saylor's most widely cited statement on this subject, that Bitcoin would need to fall to approximately $8,000 and remain there for 5 to 6 years before Strategy faces convertible debt difficulty, comes from the Q4 2025 earnings call. CEO Fong Le stated it. TD Cowen cited it in a February 2026 research note maintaining their $440 MSTR price target. But that statement addresses the convertible debt. It does not address the preferred stock dividend crisis. It does not run the full waterfall calculation from Bitcoin price decline to STRF dividend missed to compounding escalation to USD reserve depletion to capital market closure to forced Bitcoin sale. VanEck has not published that model. CoinShares has not published it. S&P's B- rating explicitly excluded Bitcoin as collateral without publishing the specific floor. No investment bank has published it publicly. This is the most important missing number in institutional Bitcoin analysis. The absence of this calculation from every major financial institution's public research output is either the most significant analytical gap in modern portfolio risk management, or it is a deliberate and coordinated silence driven by the same logic this channel described in Block 4. The people who know the number are not publishing it, and the people who would benefit most from knowing it are the retail investors who own MSTR common stock, the last in line in the capital stack, the people who receive whatever is left after $12 billion in prior claims are satisfied. This channel does not give price targets. What this channel gives is the architecture. The architecture as of April 14th, 2026 is as follows. On the supply side, 2.21 million Bitcoin available on exchanges, a 7-year low, declining by tens of thousands of coins per month through ongoing institutional and whale accumulation. Net supply contracting in absolute terms because ancient coins unmoved for over 10 years, are aging into illiquidity at a rate faster than miners are producing new coins. On the obligation side, Strategy holds 780,897 Bitcoin purchased for $59.02 billion. The company carries $8.2 billion in convertible debt, approximately $3.4 billion in preferred stock obligations, and a $2.19 billion cash reserve that covers approximately 26 months of dividend payments at current run rates. Every week that passes without new capital issuance, that reserve shrinks. On the institutional demand side, $100 billion in U.S. spot Bitcoin ETF assets. Morgan Stanley's MSBT launched April 8th as the first bank-issued Bitcoin ETF, with 16,000 advisors managing $9.3 trillion in client assets, none of whom have been directed to allocate at institutional scale yet. Bloomberg ranked the launch in the top 1% of all ETF debuts in history. On the sovereign side, the United States government holds 328,000 Bitcoin and has signed a legal commitment to never sell it. The Bitcoin Act of 2025 would authorize the purchase of 1 million Bitcoin over 5 years. The U.S. Treasury is legally positioned to be a structural buyer, not a structural seller, in any distressed Bitcoin market. And at the center of all of it, one company holding 3.7% of all the Bitcoin that will ever exist, financed by a $12 billion obligation structure that requires either the permanent availability of capital markets or the permanent cooperation of Bitcoin's price. The question Wall Street refuses to answer publicly is not a theoretical question. It is a structural one, and the answer, when you read the data carefully, is not the answer the bearish narrative predicts. The buyers who would absorb 780,000 Bitcoin in a forced liquidation scenario are not retail panic sellers. They are the deepest, most permanent, most legally constrained, never sell holders in the history of the asset class. They are the U.S. government. They are BlackRock. They are Morgan Stanley's 16,000 financial advisors with $9.3 trillion in client assets. They are the whale addresses that accumulated 270,000 Bitcoin in 30 days in a bear market while everyone else was watching the price chart. The supply was already constrained. The demand infrastructure has never been deeper. And the event that everyone is calling a collapse scenario would, if it occurred, transfer the world's largest concentrated Bitcoin position from the most leveraged corporate holder in history into the most permanent institutional and sovereign hands that have ever participated in this market. That is not a prediction. That is a description of the documented entities and the documented incentives that are already in place. This channel does not tell you what Bitcoin does next week or next year. This channel reads the architecture and lets the mathematics speak. And the mathematics of April 14th, 2026 says this. The question Wall Street refuses to answer publicly is already answered in private. They already know who absorbs 780,000 Bitcoin. They have already structured their positions around the answer. The research note does not need to be published because the trade is already on. To the viewers who reach this final frame, your attention span is institutional grade. You have just processed the structural framework that determines the most important risk-adjusted question in the Bitcoin ecosystem right now, not what the price does tomorrow, but what the architecture produces over the next 24 months. To signal that you have decoded the capital stack and understand why the silence is the signal, comment the phrase diamond stack below. That is the internal handshake for this video. Head to the pinned comment. Verify every source cited in this analysis independently. Trust the data, not the narrative. The map is in your hands.